So you're thinking about buying that first house or maybe the first rental property and not sure exactly how to do it? In this episode, I'm gonna be talking about what is a mortgage. Hey guys, welcome back. First, I'm gonna be talking about what is a mortgage, and then I'm gonna be talking about what does that even mean. And by the end of this, you're gonna know exactly how to get a mortgage, what a mortgage is really costing you, and why the banks love you. What does mortgage even mean? I'm not gonna give you a bunch of definitions here. I'm gonna give you my layman terms of what is a mortgage and what does it mean. You might have a pretty good example. You might have grew up where your parents struggled to pay the mortgage for many years. It might have been even to the worst, like where they lost their house to foreclosure. Mortgages are very serious. You have to be very serious about mortgages. So what does mort mean? M-O-R-T, mort. That means like death, right? Like mortal or immortal. Mort meaning death. And mortgage, meaning term, or AKA, put them together, death term, right? A mortgage could be considered a death term. Most people don't realize how long 30 years is. You know, if you're maybe 36 years old or 30 years old, you literally have lived as long as most of these mortgages are. And when people go to the bank and pledge to take out a death term, that secures their house. Basically, a mortgage is a promise to pay or a note, a promise to pay something back at a certain interest rate, a certain payment per month, at a certain time of the month. And if you're late, you get charged penalties, which are, late fees, which are usually pretty large, for 30 years or 15 years. That's really the definition of a mortgage. I'm not trying to be so negative. Like, I have plenty of mortgages on rental properties. It allows me to be able to use the bank's money or somebody else's money, OPM, other people's money, to buy an investment property or a property. I use mortgages, debt, to help me leverage to be able to buy more houses. So when the bank's rates go low for interest rates, they drive more people to take out mortgages, take out debt to buy properties, ultimately, which the easier money is to get or the lower the interest rate, the higher the values will go of houses and land and apartments and real estate, because it is easier to get money. Ultimately, that means it's easier for people to sell it, which drives the price of these products or commodities up. Now, when it's harder to get a mortgage or it's higher interest rate or more qualifications, ultimately that drives the market down. So mortgages are very, very powerful tools, and you just want to use them properly. So if you look at the example that's on the screen, that $200,000 mortgage at 6% interest for 30 years, if you never ever miss a payment, you pay every payment on time for 30 years, you never pay anything extra, you're gonna pay back over $431,000 for that $200,000 mortgage that you took out on that property. That doesn't sound like 6% interest to me. That sounds like over 100% interest. That is the power of compounding interest, because every single day that interest compounds on that $200,000 that you took out. And as you lower that balance, then you pay less and less and less. So if you look at that amortization schedule, all mortgages, all 30-year mortgages, all 15-year mortgages are driven by an amortization schedule. So to amortize something is to slowly kill it. If it's over 30 years, if you look at the first 5 to 7 years of that mortgage, when you first took out that loan, for the first 5 years you live in that property or you have that rental property, that mortgage is not going down very much. If you have a payment of $1,200 a month at 6% interest on $200,000, your payment's gonna be right at $1,200 a month, not including, taxes and insurance. That's just the principal and interest that you're paying back for using the bank's money or somebody else's money, OPM, other people's money. So if you're slowly killing that mortgage, slowly amortizing it, in the very beginning, if you take maybe $1,300 a month or $1,400 a month, you pay a little bit extra each month, you'll pay an extra payment each year if you make that extra couple $100 a month. So really easy math to do this. If you have $1,200 a month mortgage payment and you pay it for 12 months out of the year, if you pay an additional $100 a month, you will pay an extra $1,200 a year by the end of that year. You can actually knock off 7 years off that mortgage. 7 years, you're gonna turn that mortgage into about a 23-year mortgage, rather than a 30-year mortgage, and you're gonna save a little over $100,000 in interest that you would pay back to the bank. It's still not 6%. It's the power of compounding interest. And Albert Einstein said it best. Those who understand compounding interest earn it. Those who don't, pay it. That's why I teach a course called The Land Sharks, and I teach people how to buy land at crazy massive discounts like 30, 40 cents on the dollar and turn around and sell this stuff on seller financing at 12% interest for 30 years. Then you become the bank. You become the biggest, prettiest buildings in every city and every state in the country. And there's a reason why they're the biggest, prettiest buildings, because they make so much money off of us with these 30-year mortgages. Well, I'll tell you an actual secret, and please don't tell the banks I'm telling you this, by the way, because banks don't want you to know this. Banks love us because we go and borrow money from them to live in these houses and buy these houses so they can make this astronomical interest off of our money. But let me tell you another secret. One of the biggest money-making secrets in the banking industry is the banks pay us this little tiny 0.01% to keep our money in savings accounts. But what's even better for them is we keep money in checking accounts. How much is your checking account paying you? Nothing, right? Probably nothing, not even a 0.001% interest. They get to use that money every single day that is sitting in that bank for free, and they get to use it against their reserves. But I'm just gonna keep it super simple for this video, is because I love things really simple. That's why I love land. It's simple, it's easy, it's raw, there's nothing on it. But they're using that money for free, that they're paying you no interest on, and turning around and loaning it to us at 6% interest. And I'm doing air quotes right now, 6% interest for 30 years that we pay back over $431,000 for. That's not 6%. That's what a mortgage is. This is exactly how a mortgage works. Use this to leverage, use it to buy more rental properties. I'm not saying don't get a mortgage, because that's probably the only way you can do this. I'm saying that if there's a way for you to become the bank, wouldn't you want to learn more about it? And that's why you definitely want to subscribe to this channel. You want to smash that subscribe button, and also share this video with someone that needs to hear it. And also head on over to thelandsharks.com, schedule a call with me and my team. I'll teach you personally. I'll hold your hand to show you how to build a land investing business that you too can become the bank.